Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Portfolio Manager Don Newman joins the program today and sits down with host Pamela Ritchie to discuss the investing outlook for Q3. Don talks about the impact of cooling inflation on dividend stocks, interest rates, and the overall market rotation. Don provides insights on sector-specific trends, how technology is feeling the impact of rate changes, while energy and financials might see growth from deregulation. Utilities and infrastructure are seeing an increased demand due to the need for AI and data centers, with infrastructure investments in regions like the Carolinas and Texas looking promising. Don also notes how the Canadian energy sector companies are improving capital structures and enhancing shareholder returns through these yields. Don also touches on how lower interest rates could benefit Canadian banks and what the current real estate opportunities in the healthcare and industrial sectors looks like. Also, a note to our listeners. Andre Bruno, our Director of ETFs at Fidelity Investments Canada, will hold an AMA on all things ETFs. That's coming up on July 23rd at 12 p.m. Eastern. Go to reddit.com/r/ETFs to pre-submit questions now or ask live on July 23rd. This podcast was recorded on July 18th, 2024.
Hello, great to see you, Don.
Pamela, nice to see you.
You manage two funds. This is the Fidelity Dividend Fund and the Fidelity Dividend Plus Fund. We'll talk around both of those and get into those. What's the outlook for dividends at this point?
I think actually really good. I guess as a bit of a sort of a history lesson, the last time dividends really worked was 2021. And we had a period where we had very low interest rates, we had a pretty good economy, and the yields just looked so attractive versus the low interest rates. We got into a little bit of as interest rates went up, and they went up very quickly. So if you look from March 2022 on to just a year and a half later, we went from, I think the 3-month went from 0.5 to 5%.
Just straight up.
And so during that period, you got a sort of almost an era of sort of range bound for the dividend stocks. And basically, you had to compete against different asset classes for the first time in a number of years. So sort of money market, bonds, everything became more attractive. And dividend stocks actually kept growing earnings quite nicely. But what ended up happening is valuations had to come down as the earnings were growing to compete against the higher yields offered by other asset classes. And I think what's really interesting now is we've got a period where clearly the path, at least for short-term interest rates, appears to be down. The valuations for all the dividend stocks have actually compressed to a level where you've got really good competing yields, but the other asset classes are going to see yields that probably drop, making dividend stocks look a lot more attractive.
So explicitly, we're looking at, like, for instance, high tech. Like these are the winners and the losers of sort of a rate environment that's changing.
Yeah, so I think as your rates come down for your money market funds, you're going to see, I think we've got 2 more rate cuts priced in Canada, a couple of rates priced in the US. It becomes a little bit less attractive. I think you're going to end up seeing sort of, we talked a little bit of the rotation that's been going on in the market.
Absolutely. So would you call it a rotation? I mean, some people are calling it not, but some people are.
I think, what you're seeing sort of now is like Trump trade number 2. It's becoming more and more obvious that it looks like Trump is going to be sort of the candidate of choice in the US. You haven't seen this kind of move in sort of the Russell 2000 small cap versus sort of like NASDAQ in a long time. I think it may have been the biggest sort of relative move ever, as the market understands if Trump's the candidate, he's very sort of insular, US first. And that impacts small caps, companies that are very much US focused only. And it also plays into dividends quite nicely. So you've got the rate aspect where rates are coming down, but you also got the fact that you've got someone in the White House who's going to be a little more favor of old economy stocks, which happen to be a lot of dividend payers, a lot less regulation, less financial regulation, less regulation on actually
talking energy, financials maybe?
Yeah, financials and energy. You might actually be able to build a pipeline in the US for the first time, and they're certainly going to need more capacity with all the AI data center stuff that's going on, which also plays very well into a lot of dividend paying stocks on the infrastructure side.
Okay, let's start there. There's a few sectors we'll go through, and you mentioned some of them there. So with the AI discussion, we know a big part of the story. We've been following it, and it's been powering stock markets, certainly. The infrastructure side of things, has there been, are we waiting to build the infrastructure just because we're not there yet? Is it a case of interest rates? Build the story for us there.
So I think what's really interesting, at least for the dividend side, is there's the very obvious trades, which are the tech companies, that the chip companies, everything that is seeing the earnings flow through right now because they're selling all these things. To actually have the amount of power required for all the data centers over the coming years, you need a lot of infrastructure, and that's where old economy comes into play. That's where big dividend companies come into play. So an example is, I've talked about like U.S. utilities. For the last 20 years, utility growth, load growth in the U.S. has been about like 0.5 of 1%, almost nothing. That's projected to grow to like 2.5 or 3%. Doesn't sound like a lot, but it's actually tens and tens of billions of dollars of infrastructure required to do that. And in some cases, if you're in the right geographies, and I've got a bunch of stocks in those geographies, if you're in the North, the Carolinas, if you're in Texas, strangely enough, Indiana, if you're in Virginia, which is like the hub of where all the internet got sort of started and where everyone wants to throw sort of a lot of their data centers, you could have load growth that's like 9 or 10%, something like utilities have never seen before. And that's like demand going out for the next 10 years. And
so it's very consistent at a level
it's consistent, but it's going to take time for it to come in because you can't just say, hey, we need more power load and we need more power plants and that sort of thing. They don't come on tomorrow. So you don't see it in the earnings now. So everyone goes and plays the stuff where earnings are coming in, but you've got potential earnings growth for 5, 10 years coming in for the utilities or companies that actually supply the utilities. You need the infrastructure to do them. So it can be a natural gas pipeline. You're going to need a heck of a lot more natural gas to, and it doesn't mean building necessarily a new pipeline. It can be just sort of distributing to all the natural gas, all the power companies and hooking them up to the grid, which you're going to have to do. You're going to need you're going to have to find engineering construction companies that can actually build this stuff.
All dividend payers.
Yeah, all dividend payers. So it's a sector where you've got a combination of rates going down and a lot of infrastructure plays that pay really good dividend, where the demand, you can see it, it's coming, but it's not in the earnings yet, and the earnings will end up start growing over the next number of years, and that will should push the stocks up. At the same time, the dividends become more attractive and growing versus alternative assets.
Fascinating. Versus alternative assets. Okay, fascinating. So tell us a little bit about how, I mean, you would think, so at Fidelity, you are often in the rooms with CEOs, you get great calls of access to many of these companies that you're discussing. They're not seeing them in the earnings you mentioned, but I mean, is there sort of a forward-looking statement from CEOs at this point saying like,
you can
it's coming?
See sort of 8Ks and conference calls where the companies will start referring to, geez, we haven't seen, we're not sure how we're going to do all this. Like the demand is coming in so hot and heavy. Yeah, you know it's there. It's just
not in the numbers.
It's not in the numbers, but the data demand, the demand from data centers is just so enormous. That all the companies are trying to figure out, okay, well, how do we price this? How do we make sure that our other utility customers aren't being hurt? How do we, or do we have the manpower to actually do this? Or we're going to have to hire more people to actually do the construction. Do we have enough supply chain parts to do this? It's all coming, but it's something where there's actually lead times, and this is like a year, 2 years. In some cases, this is 5 years out, but you can see it. You can see it coming, and people are taking up their capex projections not for next year, but for 3-5 years out. And it's not by like $100 million; it's by $5 billion. Right. Like they're just absolutely enormous numbers, and so it becomes a really good story for dividend payers. Where in the past it was just like, oh, they're going to grow, mid-single digits, and it's kind of boring and whatever. But now it's going to be, well, mid-single digits may become high single digits, but it may become high single digits plus a 4% yield for the next 10 years. Wow. In which case, that's a really good, stable, I know it's coming return, which people haven't priced into stocks yet.
Wow. And therefore, the dividend growth will be there because there's such assurance that
the growth. Yeah, if you can start growing your rate base, or if you can start growing, if you're an engineering construction company, then you're growing more. The idea is if your payout ratio is reasonable and you can grow 8, in some cases for companies that aren't sort of regulated, maybe you're growing 10 or 15% a year. Maybe your dividend starts growing at 10 or 15% a year too, because you keep your payout ratio the same. So there's a lot of really good things happening. And on the macro front, you've got sort of the tailwind now that you don't have to fight higher rates, which really forced multiples down. And so you start from a level where dividend stocks are not that expensive. Rates are coming down, so they look cheaper versus other asset classes, and the actual fundamental story for a lot of sectors is actually starting to get better. It's a really good combination.
One piece of the fundamentals that's starting to get a lot better is the companies, and often these are large capital-intensive companies, if they've had to delever, they've done that by now,
yep.
right? They're finished that work at this point, so they're looking pretty, like their balance sheets are looking pretty good at this point. They've taken the pain.
Yeah, one example I'd used is like Canadian Energy. They went into the downturn, a lot of companies over-levered and not really able to function at prices of $40. A lot of them have said, listen, we're never going to get into that trouble again. And what we need to do is take our sort of cash flow up and debt down to a point where the oil price can go to $40 and we're still fine. And most of them have now gotten to the point where their capital structure is a point and their debt is to a point where everything works at even a lot lower energy prices. And they're now saying, well, we don't need to spend the money paying back debt anymore. We're just going to give it all back to shareholders. So you've got these yields, which may be in double-digit free cash flow yields. And it's not going to debt anymore. It's not going to pay off the debt holders. It's going to the shareholders. So it's dividends, which are rising, and then share buybacks. And on top of that, for Canadian Energy, we've gone through a period of about a decade where most of our energy companies traded at a discount because we frankly had the term is egress. You just couldn't get the energy out because we didn't have the pipeline capacity, but we now have the TMX pipeline that's just come on. It's 590,000 barrels, and we've got some other stuff behind it. So for the next at least 5+ years, if not longer, we've got a country that's got the 3rd largest reserves in the world, and we can actually grow volumes a little bit, and we can actually ship to the rest of the world and not have to have these really wide differentials. That means we're selling at lower prices because we can't find the capacity to get it out. So you've got payout ratios, or you've got the ability to pay more back to shareholders in the forms of dividends and buybacks. And you've got the ability to actually ship things out of Canada. And that's wonderful also for midstream and pipeline companies that haven't been able to grow volumes. And now they've got, volumes can actually increase because from producers, we can actually ship more. And if you're a midstream producer, that's basically, price times the price you ship it down at basically, and the quantity you ship it down at, and quantities are going up, your earnings start going up. So that's actually a good story as well.
Total return is all there. Fascinating. So let's go back to this rotation that we talked about at the beginning a little bit. Sure. Part of it has to do, as you mentioned, with the Trump trade. Within that story, you're starting to hear the deregulation piece. This is more for the U.S., but it makes you question, companies across the border, actually, on the deregulation. What are some of the opportunities there? They often tend to be, big companies, regulated, and probably dividend payers. Yeah,
I think people are fairly rightly assume that Trump is not in favor of greater regulation, and probably will roll back some of the regulations. So it's going to be potentially, we could see it again, lower taxes. And that's generally
corporate taxes.
It could be corporate taxes, could be personal taxes. But he's not in favor of higher taxes and probably rolling things back. That's probably good for some corporations. You'll probably see less financial regulation, so that's probably good for financials. I mentioned you probably can. He likes old economy. He actually likes coal. Whether you like that or not, don't know. But that's probably good for a lot of infrastructure things that have not been able to build in the U.S.
because they don't have the energy to do it.
Yeah, like if you're going to need all this natural gas to power the power plants that power the AI, being able to actually build something for the first time in a decade might be really positive. I think there's a lot of things that potentially are driven sort of older economy, good dividend payers that see less regulation and potentially a little bit lower taxes, that the market, and once again, sort of very sort of insular focused, on U.S., and it can affect a lot of Canadian companies that sort of trade into the U.S. And a little less of the sort of the global view.
There's a question coming in that fits into that whole thing. This is zeroing in on Canadian banks themselves. So sort of the financial story, perhaps the deregulation story, although Canada's a very regulated banking. We're really regulated. It's the total opposite. In that sense, we don't have very many of them. So does any of it translate here?
Not necessarily, but I mean, we have seen with Canadian banks just in the last week or so, sort of regular OSFI decide to put out sort of increasing capital requirements on the banks. So, I think the banks, and the banks also have, a lot of them have sort of U.S. Subsidiaries, and that's positive there. I think Canada will remain relatively highly regulated, but where things are positive for banks is if you actually start to get lower interest rates. Now, I don't want interest rates falling off a cliff, because that's a weak economy. That also impacts your net interest margin. So but
the interest rate sensitive sectors are of more interest.
But you get a couple cuts, and suddenly the consumer is like, okay, like I feel they're a little bit better. The weight's taken off them a little bit more. Mortgage rates hopefully come down a little bit. There's a big refinancing. A lot of refinancing of mortgages that has to be done in 25 and 26, especially versus how low rates were in 20 and 21. That becomes a little more palatable, and the consumer can kind of work their way through, which hopefully sort of slows down the sort of growth in provisions for credit losses for the banks, and you sort of in the economy itself, knock on wood, sort of goes into kind of a soft landing mode.
Yeah, fascinating. We've got plexiglass here. We'll have to find some wood somewhere. Yeah, there'll be wood somewhere. Tell us a little bit about real estate, the commercial real estate. Again, we were talking about actually energy companies and being overly levered and having to take some pain. The real estate companies, the commercial story has been taking a lot of pain.
It's especially been acute in office, and I think that it's an area where certainly lower rates will definitely help office. I'm not sure the office story gets a lot better. There's no real AI play here, but what I would say is, like, you can see even the last sort of week or two, the real estate indexes have started to work their way up, and these companies are in. This is what's really kept them under check for the last couple of years. Is they're relatively highly levered. Rates going from 0.5 up to 5%, and then put a spread on for their cost of debt, has been really painful for a lot of REITs. On the flip side, rates coming down is really good for a lot of REITs. And that, in combination with the fact the last 2 years, as rates have gone up a lot, there's a lot of supply that was sort of in the hopper. It's kind of coming on right now and kind of peaks this year. But when rates went to 5 and you added debt spreads on top of that, the supply of new buildings, like whether it be industrial, whether it be healthcare, whether it be apartment buildings, slowed down dramatically. And that pipeline sort of stuff that gets sort of fed in the system kind of peaks this year and then slows down. So supply and demand starts to look a lot better next year. And I think a lot of the sort of the sectors are starting to realize that, like U.S. multifamily kind of peaks out this year. The stocks have actually been pretty good, even though fundamentals, rent growth hasn't been particularly good. But the stocks got relatively cheap. We're pricing in like sort of 6 caps. And if rates come down, you get really good assets with a good dividend yield trading at a pretty high cap rate, where it looks like fundamentals are going to actually start to bottom out or improve next year. And I think the sector is starting to sort of feel a little bit better, and that there's some value there. And so there's you get lower rates, people might move out again. So they go and put their stuff in storage. So storage REITs have been relatively strong. You can go. We talked about it sort of irrespective of rates, but people coming out of the pandemic weren't able to put their families in senior care. So senior care, as we've moved out of the pandemic, has been terrific, because families have been able to put sort of their loved ones who are older in senior care. It's been a really good sector. Industrial, the supply is pretty big this year, but will slow down next year and hopefully start picking up. And if you get an improvement in the economy with lower rates, that's good for industrial. So there are a number of sectors where you can kind of see that dividend yields were good, valuations had come down, and fundamentals are kind of bottoming out and should hopefully improve into 2025.
It's really fascinating how you're looking at sort of this so-called renaissance in AI and sort of the next leg and where the power story needs to come in there. Does it go so far as, do you end up looking at, I'm thinking of nuclear, which is sort of one of the stories there. So do you go into that commodity, or do you stick closer to?
I think the commodities actually, or uranium has been really good, and the secular outlook for that is good. Things have run a lot in that sector.
They have run a lot, yeah.
So I think one of the interesting, obviously, anyone that's got nuclear capacity that can is extraordinarily loved by data centers.
Right.
So if you have a utility, and I own a couple where you've got...
Okay, so you do own some commodities.
They actually have large nuclear sort of sections to them. It's really good because it's unlike solar and wind, it's 24-hour-a-day consistent load that's clean. So all the big companies...
Can be stored.
Yeah, all the companies that are trying to do the data centers, the Microsofts, the Googles, everyone wants the nuclear load because it's good for the environment, so they take no abuse on that front. And to run a data center, you need the power going 24 hours a day to power all these models. And that's what nuclear can do for you. There's no ebbs and flows for it. So it's a really valuable commodity, and companies that had uncontracted nuclear have had a huge run this year. But I also like the ones that have contracted nuclear because it just looks like it's going to be, it's a great asset for years and years to come.
Let's dig into the fund itself and tell us the difference between the dividend fund and the dividend plus. Mm-hmm. But within that, just sort of getting the sense of the diversified portfolio. Yep. There's been lots of discussion about what goes into a 60-40. You're obviously looking on an equity side.
Yep.
The yields have a different story now, and bonds are providing a pretty nice coupon clipping opportunity there. Still are in a lot of cases. Tell us about where you think the dividend fund fits, and then we'll go into the difference between the two in a minute. But where do you think it sort of fits right now?
Okay, for people that I think I talk about this most of the time on here, but we've got dividend fund that tends to be a little bit more of a diversified portfolio than dividend plus. Dividend plus is a little more of an infrastructure focus.
Okay.
And always more of a sector, and always have been. Yeah. It used to be back in the early 2000s. It was our sort of income trust fund, and I've tried to keep sort of it kind of steady on the idea of it's kind of more like an infrastructure type fund. Dividend plus is kind of more a little bit diversified. I think where your dividend fund fits in is just it's always just a really core holding for people that are interested in income and income that's growing. And I think that's what's really going to differentiate it over the next couple years, because we had a period where, frankly, your cash was growing in income. Yeah. But if we start every month now, or every few months, if we start getting interest rate cuts, what you're going to see is your income actually, at the same time where prices are still going up a little bit, they've slowed down, but you still need to pay for things. But the money you're getting from your bank account, or if you're renewing some kind of fixed income thing, or if just your money market account is actually going to start to shrink. And so every month you've got the same amount that you need to pay for your mortgage, your car payments, your groceries, and you're actually going to be seeing less and less coming in. Where the dividend fund comes into play is it's the exact opposite. And you've got good rates, and now every 3 months, every year, whenever dividends, the companies are actually raising their dividends along with earnings. So your dividend flow, you got a good yield, but that yield is actually growing for you, and the payments are actually growing every month. And I think over the last couple of years, it probably hasn't mattered that much, because you could go and say, hey, I'm just sticking my money in a money market fund at 5%. Yep. That's okay, and frankly, as a conservative investor, I have no issue with that. But if that 5 just became 4.75, by the end of the year it's 4.25, if next year it's 3.5 or something like that, that's a big hit to your income, where you can go and buy dividend stocks that are now still priced relatively attractively. You got a really good dividend to start, and that dividend's actually growing. The payment's going up every year, and it goes and it can help you pay for your kids going to summer camp, your all the expenses that you have that probably are still not going down over the next number of years. So it fits in really nicely as just growth in income at a very reasonable price right now, because the rest of the market has been very much in focus. Sort of the growth area of the market has been, it's been wonderful, but it's been very, very focused. And a lot of the dividend stocks have kind of been ignored because they hadn't fit into the immediate growth earnings, explosive growth earnings that tech has seen, but they've kind of been left behind. And I think there's now a time where, as rates come down, you can kind of rotate into those. And a lot of what I'm doing in the dividend fund is just actually trying to find higher yielding things that may have been left behind in the last couple of years.
That will now also
and that actually, it's like, wait a sec, that dividend yield looks really attractive. People didn't care about that at 5% interest rates, but at 4 or 3.5%, that dividend yield is going to become a lot more valuable, and it's going to get bid up. And I'm sort of shifting the portfolio a little more into sort of some of the higher dividend yielding areas, which I think could benefit as rates get cut.
Question rolling in here for you, Don. We'll do this before we close out. So, what is your view on the communications sector? Are the headwinds behind us?
Yeah, that's been a sector in the market, especially Canada, that's been. And I think you and I talked a little bit about it. It's been tough. You basically have had. You're not supposed to use the word, but I'm going to use the word like an oligopoly, where people are not playing nice in the sandbox. Yeah. So the companies need to learn to play nice in the sandbox. And
what's that mean exactly?
It's been one of the few sectors where you've had inflation across the board,
right.
And everyone took price, except the telecom companies. So what that playing nice in the sandbox means is taking a little bit of price. That doesn't mean gouging consumers, but it does mean if you're providing more services, if you're putting CapEx into the ground, you take a little extra price, because there's been volume, there's been immigration, and that's been a really good story for telecom. But the price competition has been fierce, and they need to back off as an industry, back off. And it doesn't mean jacking prices, it just means backing off a little bit. The dividend yields are good. The payout ratios in a couple cases are probably a little bit too high. They need to grow in, and my suggestions to the companies have been, listen, if you think you can grow earnings at 5%, grow the dividend at 1%. No one cares about your dividend growth at this point. Your dividend yield's already too high. You need to bring the payout ratios down a little bit. So they are in a sector which is a little bit over-levered. It's a sector where we need to get a little bit more rationality, and promotions need to come down a little bit. And we're seeing a little bit of that, but I want to see the companies, act a little bit more sort of rationally in terms of pricing.
Okay, interesting. It's great sort of nuance to the entire sector there, particularly in Canada. Just to close out, because we talked a lot about actually the excitement of the moment right now for dividends, and it sounds generally that way. For those concerned about the downside risk, just again sort of play into how some of these companies generally are a bit of a ballast against the downturn.
So what I'd say is, one is just sort of relative underperformance versus other things that have gone crazy. So the valuations, because of higher rates, the valuations on all dividend stocks have actually been pushed down to compete against the other asset classes. Mm-hmm. So you've got valuation, that's totally fine. It's not extended at all on most of your dividend stocks. You've got a good yield. Yield always acts as a sort of a buffer to the downside, because you're going to, especially as interest rates get cut, you still get paid. Even if things get tough, that dividend yield is still there. And then on top of that, you've got fundamentals, which in a lot of the sectors look like they're getting a little bit better and maybe inflecting to the upside. So it's lower rates, good valuation, and
you get paid.
You get paid, and the fundamentals start probably getting a little bit better. So it's a really good combination where things are kind of all coming into place in a sector where you don't have to go and look at the chart and go, geez, do I need to buy it up here? Right. I can actually sort of buy it at a pretty reasonable level where things are just starting to inflect to the upside.
Fantastic. Such an interesting moment to be speaking with you, Don, in particular, just to kind of get that moment solidified. Thanks for joining us.
Yeah, my pleasure, Pamela, as always.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.